Roth or not Roth? That is the question. That's what we're going to be discussing next. Hey, this is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're helping federal employees gain clarity about retirement decisions. If you need help, go to christycapital.com, click on Talk to an Advisor. One of those decisions is to Roth or to not Roth. Now, most of the federal employees that we talk to have an overwhelming amount of money in traditional as it compares to Roth. And that's because there's an upfront tax benefit for contributing to a tax deferred account. You get to take the tax deduction now in hopes that you're going to be paying taxes later at a lesser rate. And the government was even okay with postponing taxes for later. They even promoted it with the rules that they set up. But there are some new provisions in the Secure Act where even the federal government is now willing to do more Roth sooner, and they're even encouraging you to do so. It seems like Congress no longer wants to wait a long time to collect taxes, so they're willing for you to do Roth now to go ahead and pay some of the tax burden now. Some of these new provisions in the Secure Act allow for the matching funds you receive from your employer-sponsored plans to go to Roth. That would enable you to contribute Roth and then be matched to Roth as well. So now the government, meaning Congress and IRS, they allow it, but the 401k providers also have to allow it. And right now the TSP does not allow that. So you can't match funds to Roth yet. Maybe this will change in the future. Another way that Congress is encouraging Roth is that if your income is above $145,000 a year in the previous tax year, you must contribute your catch-up contributions to Roth. Now, having traditional catch-ups is not going to be allowed anymore if your income is over $145,000. Now, depending on when you're watching this video, the rule may be in effect and it may not be. The IRS postponed the rule, so it will be happening if it's not already happening. Effective in 2024, the 529 college plans, the beneficiaries will be permitted to roll over up to $35,000 penalty-free from their 529 plan to a Roth IRA over the course of their lifetime. This is just another way of encouraging Roth. So it definitely seems like the government is encouraging more Roth avenues, which means that more taxes will get paid sooner rather than later. As a federal employee or a federal retiree, you have some options on whether you want to do Roth or not. If you change your contribution and start contributing directly to Roth, it'll mean that your bring-home pay is going to go down by the amount of taxes that you have to go ahead and pay. So if you're maxing out the $23,000 a year to TSP and you're doing it all traditional, and then suddenly you switch and you start doing $23,000, let's say, to Roth, you'll have to go ahead and pay taxes and then send the $23,000 to Roth TSP. The difference comes out of your paycheck. So you can contribute to Roth IRA as well as Roth TSP. Now, there are some income limitations that may phase you out if your income's too high for a Roth IRA. But keep in mind there are no income limits inside of Roth TSP. Even the highest paid federal employee can contribute to Roth TSP. With the changing of the rule, if your income is over $145,000, any catch-up contributions to TSP will be forced to Roth. If the TSP ever changes their stance on allowing matching contributions to go to Roth, you can do that as well. Now, keep in mind, if you match to Roth, you're going to have to pay the taxes that would be owed on that. Another great way that the federal employees and federal retirees can get money to Roth is by doing Roth conversions in an IRA, because the TSP, they don't let you do Roth conversions. If you're 59 and a half and you're still working, you can move money out of the TSP into an IRA. If you've retired or you've separated from service, you're just not a federal employee anymore, you can move your TSP out into an IRA as well. And in an IRA, you can do Roth conversions where you take a portion of your traditional money, you move it to Roth. Go ahead and pay the taxes in the year that you do the conversions. So should you do Roth or should you not do Roth? Well, the solution really comes in two parts. It's really a mathematical question, and then you have to look at what you think future tax rates are estimated to be. What tax bracket are you in today? What tax bracket do you think you'll be in retirement? What do you think the tax brackets will just look like in the future? What number will be on the bracket that you're in? Do you think it's more likely that the government will raise taxes in the future, lower taxes in the future, or keep them the same? For the clients that we work with, we'll do a financial blueprint for you that'll show you what we think your tax future looks like. If you leave everything like it is, which means your assets are mostly traditional, what does your future taxation look like? Now, this is just an estimate because no one knows what the future holds. But we can also look over a scenario where we help you do some active tax planning to shift money to Roth. We can look at future estimates of what taxation will look like for you, and then you can decide. Now, does it make sense in every situation to shift to Roth? Well, no, it doesn't make sense in every situation. But does it make sense in the majority of situations? Like 51% of situations, does it make sense? Hopefully our compliance officer will let me keep this in here, but I would say it does. It makes sense for the majority of people to do some type of tax planning. But does it make sense for you? That's the question. If you need help determining if it does, then reach out to us at Christy Capital. We'd love to help you. If it's right for you, then it can make a real big difference. If it's not right for you, then you shouldn't do it. Another benefit of Roth is how it's treated when you leave it to your beneficiaries. In this video right here, Roth IRA or life insurance, which is better for leaving a legacy? Check out that video. If you want to sign up for a federal retirement webinar, go to christycapital.com/webinar to sign up for it. My name is Mel Stubbs. I'll talk to you soon.